Indian stock market is very expensive. Falling is an opportunity. Just sit tight on cash. So stay alert. Why Indian market is suffering. Hi investors and traders, welcome back to the channel. And this video I'm making for you on 20th of September. And whatever data you're going to get with respect to today. So a lot of you must be wondering why Indian stock market is falling. So I have collected a few reasons and I'm going to be discussing about them. And you can just, I'm sure you all know about it, but just putting in perspective. And in case you want to get in touch with my team, you have all the contact numbers, or otherwise you can go to the description box of any video and you'll find the contact details or the website's address or the Telegram channel, everything over there. In case our Telegram channel doesn't work, you can contact our team and they will help you out. Now, basically what's happening, why stock market is falling down. One is weak global environment dragging the Indian stock market also down. On 28th September in the morning, roughly about Sensex was standing at 56,851, almost 255 points down, which is 0.45%, and while Nifty 50 has fallen about 60 points and it was trading at 16,4946, which is about, it has broken a psychological level of 17,000. Now, what are the reasons that can be, attributed to this decline? This decline can be attributed to the bearish global trend. There is a 30% drop in Nasdaq and a 24% drop in S&P 500, and the Euro stocks have fallen almost like 24%. Markets in developed nations are clearly bearish. Nifty's decline from its peak is only 8.5% in India. The fundamental strength of Indian economy can enable it to remain an outperformer. The country cannot be immune to major global trend. Now you must remember one thing, that US is going through inflation, very high rate of inflation. Europe is going through the energy crisis because of the Ukraine-Russia war. Because of that, there are rising costs even in Europe. So Europe and US both are right now going through huge inflation, which is a very, very huge worry. And to counter that, what is Fed is doing? Fed is continuously increasing the rate. So in view of Federal Reserve interest rate increase, ICICI Security expects the US economy will suffer from a negative impact. US economy activity can go to the markets in the second quarter of the fiscal year 2022-2023. Then on the other hand, the Fed Reserve has said that it can tolerate a recession in the US economy to control inflation. Means the stance of Fed is at this point of time very, very aggressive. We will talk about 7 reasons why there is a bearish stance in US and UK. Why there is a bearish stance in US and Europe. So first and foremost, Fed is taking very aggressive stance to counter inflation. They have already increased 0.75% interest. Then again, they have increased on the same basis, and then again they are planning to increase in November by 0.75%, then 0.5% in December, and 0.25% in February. It's one of the steepest hike by Fed rate. Now the question comes, why Indian market is suffering? If US is going through inflation or recession or whatever, why Indian market is suffering? Now the whole thing comes down to one thing, that in general US rates are very, very low. Like G-Sec or the government bond rates are very, very low. But now the government bonds, which are supposed to be very, very safe, the rates are very, very high. Now what will happen? FIs who were interested in India will pull out their money and go to US, where they find more high rate of interest. So what will happen? There will be a crunch on the liquidity. Liquidity is going to be very, very less in coming at least 1 or 2 years. Let's go on to the further reasons. The global trade forecast will be revised by the World Trade Organization chief. In view of this, with Reuters on Tuesday, the World Trade Organization Director General said she expected global trade forecast for 2022 to decrease from the current 3% because of ongoing Ukraine-Russia war and related food and energy crisis. Currently, we are revising our forecast, but it doesn't appear very promising. According to the Director General, all indicators point to a downtrend. She said without giving specific figures, the outlook appears gloomy. So at least the year of 2022 is going to be really challenging the way it looks. Global trade growth is already forecast to increase by 3% from 4.7% by World Trade Organization in April. As of 2023, the economy is expected to grow by 3.4%, way below than 4.7%. Now the third point why India is suffering is because dollar is at record high and the rupee is at record low. Today, rupee even touched 82. It peaked at 81.9 rupees. So, on the back of rising treasury yields, the dollar reached a new two-decade high, while sterling was at a record low as concern over Britain's radical tax cut. A new high was reached by the US dollar index in India trade, where it was up by 0.4% at 114.62. As the first time in 2000, since 2010, 10 years treasury yield topped 4%. It is a very great concern why the treasury yield is increasing. Treasury is supposed to be one of the safest way to invest in US market. If treasury is giving such a high return, why would any institution will go to any other instrument? They will put their money in the treasury. A Reuters report reported a 2.29% yield of the 2-year bond, which is again very high. It used to be somewhere around 1.25, 1.5%. And current moment it's 2.29%, which is supposed to be very safe returns. Then fourth point is strictness of RBI. The Reserve Bank of India has also tightened its stance. According to the experts, the central bank would raise interest rates by 0.5% in its next meeting of the Monetary Policy Committee and by 0.35% in December. Next year, the central bank may also increase interest rate by 0.5%. Consequently, the repo rate will increase to 6.7% by April next year. RBI's MPC meeting is scheduled to be held on 28th to 30th September. In coming these 2-3 days, we'll have the RBI's meeting as well. The seventh indicator is the indicator of Indian economy is low growth. Growth forecast of the Indian economy have been downgraded by many agencies, with GDP growth of the June quarter falling short of expectations. Asian Development Bank reduced India's growth forecast from 7.8% to 7% in this financial year. In the quarter of 2023, Moody revised India's growth outlook to 7.7% from 8.8%. So these are 7 reasons. So I hope you all understand. One is the worry of inflation in US, the Europe facing high inflation due to the energy crisis, then Fed increasing the rate, repo rate, then RBI tightening its stance, then rupee being weaker and dollar becoming very strong, and then Indian economy is being downgraded. The GDP growth is expected to be low. Putting all of it, the scenario doesn't look very promising. A market can slide further down another 1,000-1,500 point. Not that it may happen tomorrow. There could be some bounce and then further slide down, or they could be straight fall. I'm not predicting anything. But there is a weakness in the market. A downfall is definitely expected. So stay alert. Like the reason of making this video is only simple, that I want you to be alert. I want you to have clear, like either you hedge your positions or you exit your positions and take entry later, whatever you want. Or if you're a long-term investor, you don't need to worry about it. Probably you can do some kind of averaging at the lower prices. So be prepared. Being prepared in the stock market is really an important thing, and sit tight on cash. You know, like I was speaking to my son yesterday, and he's in US and he invests in US market. He was asking me, what do I do? Where should I invest? I said, just sit tight on cash, let the market fall. He has got a portfolio of $500,000, and it is probably at cost or maybe below cost. And I said, just hold it tight. We'll average all the stocks when it falls further down. So falling is an opportunity. When market is going up, it's time to book your profits. Right now, sit tight on cash. There will be opportunities. Beautiful stocks will be available at a very cheap rate. And trust me, Indian stock market is very expensive. I just want to conclude with my last slide. Yeah, Indian stock market has experienced a huge increase in the share prices, which has led to high valuations as compared to the global and Asian stocks. BNP Paribas said Indian shares have an unsustainable premium valuation. Investors are advised to be cautious with Indian shares in the absence of market supporting factors. So stay light on your cash positions or hedge your position. Do something, or like don't stand on a long, don't build up your long positions, huge long positions. So do whatever you can. Maybe you have keep your cash intact right now, and when market falls further, you can average your cost in good stocks. So idea of making this video is to really keep you alerted with what's happening in the market and what should be your stance. Keep following these factors. Whenever dollar softens a little bit, whenever Fed rate or RBI softens a little bit, market may see a bounce. Until then, just sit tight with your cash and opportunities will come to make good amount of money. Don't worry about it. Till then, it's a good opportunity to learn. Watch my videos of past and keep earning, keep learning. When we can't invest in the market, it's time to learn. So you have opportunity to learn right now. Invest all your time, not money, your time in learning about stock market. Stay tuned. All the best. See you in the next video.